Welcome to Investors Insights. Our topic today is Russian roulette. We've got a lot of topics to discuss in terms of what's going on in the world, what's taking place on interest rates domestically, and also from the standpoint of student loans. There's three topics for you. I'm joined today by my distinguished colleagues, Bobby Norman, Trey Booth, and Ty Miller. And we've just come out of our portfolio strategies meeting discussing all these issues that we're getting ready to share with you. So, and as always, we will continue this dialogue throughout the week on Twitter, Facebook, LinkedIn, our podcast, our blogs. So please stay tuned. But with that, I want to start off with Trey. Trey, the topic this morning is focusing on Russia and what took place over the weekend. People have been very nervous about that. Can you elaborate? You gave some great data in our meeting this morning.
Yeah, absolutely, Greg. So never have I seen a news story catch fire so quickly over the weekend and create so much, question and communication between our clients and ourselves, only to have the market open up pretty much ho-hum. There was, I can't believe I'm saying this, an effective attempted coup in Russia over the weekend with the Wagner Group at one point marching on Moscow. Now, when the markets open today on Monday, that seems to have been completely quelled. But what it does do is create a new what if. This war between Russia and Ukraine has been at a stalemate for over a year now. And a lot of the uncertainty around it kind of seems to have been removed. The markets really don't react to any news one way or the other. This created a new what if, where what would happen if there was unrest in Russia and how would that impact our markets? We kind of saw this, though, back in February of 22. When the war in Ukraine started, our U.S. oil market spiked to nearly $120 a barrel. That's the market's perceived risk if Russian oil were taken off the market. And so right away, we thought that at that time that Russian oil would be removed. Through sanctions, we limited the export of oil to Europe and the U.S., but we didn't stop it. It's just moved to where it's going. So Russian oil is still pumping out there. And so if you were ever wanting to produce unrest within Russia, that's exactly where you'd want to go. That's where the power base is in that money being driven from oil production, oil sales globally. And so if we were to see any kind of continued unrest, it would likely happen in the oil markets exclusively first. Russia as a whole, as an economy, is extremely small and has almost no impact on us. It's just a very large energy country, and that's where the impact will be felt, not market-wide. And that's what we're watching closely. And that's what we saw over the weekend, spike drastically and then recede before markets opened.
I thought that was great insight on your part, Trey. And of course, here we are in the summertime, travel and everything else. And all we need is to see oil prices and gasoline prices go up. So thank you for giving that explanation, because it's definitely in the news media today. But I think you gave a great, concise picture of what's actually going on. And Bobby, at the same time, people are still concerned about what's going on with the Fed. Here we're talking about oil prices, gasoline prices would go up if something happened in Russia like that. Still a big debate about interest rates. Will they go higher? Will they go lower? Is inflation starting to subside? So talk about what happens and what we're seeing with the Fed and moving forward.
Yeah, with the Fed pausing its rate hiking in June, I wanted to go over what that historically means for the stock market and interest rates. So looking back in history, over the last 35 years, there have been 5 monetary policy periods when the Fed paused after a major rate hiking cycle like we're currently in now. During these periods, it took anywhere from 4 to 15 months before the Fed started to actually cut rates, with the average pause lasting about 6.8 months. So as expected, the Fed paused its rate hiking cycle after 15 consecutive months of tightening this month. So what happens to the market and interest rates? Well, as you can see in this first chart, while the number of occurrences is limited, stocks have done relatively well after a Fed pause following a major rate hiking cycle. The S&P 500 traded higher over the following 12 months after 4 of the last 5 pauses, as you can see in this chart here. The average 12-month index return for all these 5 periods seen on this chart was 16.4%. That's great. The outlier year was the pause in May of 2000, as you can see in that declining black line in the chart, 2 months after the S&P 500's dot-com era peak. Also, seen in this second chart here, Interest rates have historically declined after a Fed pause. That's good news. The 10-year Treasury yield has declined after all 5 Fed pauses, as you can see in this chart here, falling by an average of 13.7% over the following 12 months. So history says a Fed pause is good for the markets and can be good for interest rates falling. And so history, we'll see what happens here, but history says it's a good thing.
Yeah, very much so. Well, as we like to say here at File Plan Partners, history may not repeat itself, but it sure does rhyme. And so we like looking at the historical data and see what the rippling effect is going forward if this occurs again. And I thought that was excellent on your part to bring that out in today's meeting. So thank you for that detailed work. And, here we are, folks. We're talking about the global picture. We're talking about the domestic picture. And now let's go straight to people's wallets and the impact on consumer spending, as well as what's taking place. A big topic these days is on student loans. And people will say to us, why are you tracking student loan data? Well, Ty Miller, I think, has got a great explanation for you this morning as to why we think that's so important. Ty, thank you for taking on this topic, and we want to hear your insight.
I mean, obviously, student loans are very important. We expect in the coming days and the coming weeks a Supreme Court decision that will impact student loans. Now, of course, student loans, no matter what this court decision is, they're set to start picking up interest again in September with the first payments beginning in October. This will be the first time people are paying their student loans with interest, are forced to pay their student loans since March of 2020. There are college kids, 2 years out of college that they've never paid student loans before, not required to, at least they've never had interest with it. And so this is going to be a big impact to consumer discretionary spending. As you can see in this chart, we're talking about on average $383 a month in student loan payments. For people between the ages of 18 and 29, student loans account for nearly a third of all their total debt. I mean,
I really appreciate that statistic. I really appreciate you throwing that out. Say that one more time for our folks.
Yeah, so student loans for 18 to 29-year-olds account for nearly a third of their total debt. I mean, huge amount. Credit card, mortgage, HELOC, auto loans, and we're talking about student loans, a third of all that. So, we'll kind of dive into the Supreme Court aspect of it. So the Supreme Court, they'll have a decision if they want to uphold the plan to forgive $10,000 to $20,000 of the student loan forgiveness, depending on your income. In which case, if they choose to uphold, that'll result in about a $400 billion expense because there's about 40 million people that'll be eligible for this program, 16 million of which have already applied back when it, became big news. They've already been approved. So we expect that to go into effect pretty quick if the Supreme Court rules to go that way. However, if they rule that's not the way they want to go, that can't be done, we do expect President Biden to unroll a new income-driven plan immediately after that decision. So the 10 to 20,000 immediate forgiveness will be, could be denied in this case. And then after that point, President Biden will come out and talk about a 5 to 10% income plan. So based on your income, you basically pay 5 to 10% back on your student loans each time, or each year, I should say. And then after 20 years, the balance that is left will be forgiven. And so this could actually result in higher, cost because, if you pay off, 10 or 20,000 is forgiven and you still have 100,000 out there, you still have that big bill. But if, you're just paying basically interest back every year, and then at the end of 20 years, it could still be inflated by a good number, and all that's forgiven, that could be, quite a larger expense. And so these are kind of the different scenarios we're looking at, and we'd like to see, what the Supreme Court rules. And as soon as they do, we can, of course, go more in depth on, which route that'll be. But the important, thing to note is that student loan payments are going to pick up again, interest in September, payments in October. This will be the first time for a lot of people in that lack of, discretionary spending can impact the markets, impact your daily lives, everything like that.
That's excellent. And it also gives insight because here at File Plan Partners, we not only are looking at the impact it can have on economy and markets, but we also in our financial planning process or your financial house planning, is that we have people come in here, and student loans is definitely a topic. So it's very important in doing your planning, whether you're planning as a grandparent to help a grandchild out, a parent that's got to fund college, or you're now a graduate and dealing with student loans. We deal with that topic a lot. So with that said, folks, we are approaching the 4th of July holiday coming up. It's hot outside. People are traveling. We know you've got a lot of things going on. We're going to keep you updated on all these topics and the impact it could have on the economy as we go in the month of July. We hope you have a great week, and please share this with others that you think will enjoy learning more about these topics. Thanks again. Take care.